Hi, I'm Ty, and this is my gardening accountant video series. And in this video, I'm going to talk about why your LLC minimum gain matters. And the punchline to this is that it often doesn't matter. Really, the most common context where you would run across the concept of minimum gain in dealing with LLC taxation is if that LLC is owning real estate and you're allocating real estate deductions to the various members, which is a fairly common scenario for people who happen to own real estate or happen to be in that industry, but doesn't apply to the broader set of possible LLCs out there. And also, this is very technical, so I think that this video is probably more for the accountants and the tax advisors who may be working with the entrepreneurs. But if you are an owner-operator of a business and you really want to get into this level of detail of technical information, please watch and let us know if you have questions. So minimum gain is a technical tax concept that is found in the Treasury regulations covering and the regulations that specifically cover partnership tax law. It's used as a justification for deducting losses or distributing cash beyond your investment in an LLC. You know, it's always precarious for an LLC to be making allocations or distributions that lack economic effect, because that opens the door to the IRS reallocating things based on their opinion about what the actual economics of your business are. So we would always advise that you have allocations that meet the economic effect standard in the tax regulations. And so the primary concern in this regard, or what I should say is the dilemma or paradox in this regard, is when an LLC borrows money on a non-recourse basis. And the most likely scenario they'd be able to do that is if the LLC was borrowing money to purchase a real property asset. Under tax law, we call a loan that owners of the LLC are not personally liable for a non-recourse debt. So if the LLC was able to borrow money to buy real estate and the bank or the lender did not require liability or personal guarantees or co-signing of the individual owners of the LLC, then that would be a non-recourse debt. It's important to note that the lenders and real estate professionals may use that term non-recourse debt differently than we do for tax purposes. So when we say non-recourse debt from a tax advisor standpoint, we mean a debt that the LLC members are not personally liable for. So as an example, suppose we have an LLC with two owners, Bill and Ted, and they each contribute $10,000 to the business. The LLC then purchases a commercial real property for $300,000 with a mortgage of $280,000. They use the $20,000 that Bill and Ted put in as their down payment. They borrow $280,000, and that's where they get the $300,000 to buy this real estate. If Bill and Ted are not personally liable for the mortgage, we would call that debt a non-recourse debt. Now assume the commercial property breaks even in terms of profitability, so rent minus expenses is an even zero, except for depreciation costs, that the depreciation expense creates a loss for this LLC. Now, for the sake of illustration, let's assume that depreciation for this property is $30,000 a year. Now, I'm just making that up, and yes, that's probably faster than you generally would expect for commercial real estate property, although there's been a lot of there's a lot of opportunity to take accelerated depreciation now in the tax years that I happen to be making this video, but setting that aside, I'm not actually doing a real depreciation calculation here. I'm just throwing out a number for the sake of illustration. So just assume that your operating expenses and your rent come out to zero, and then you have depreciation of $30,000 a year. So this LLC is running at a $30,000 loss per year. Oh, and you know, whether you could get away with no guarantees on the loan and only 10% down, right? These assumptions may not play out exactly that way in real life, but I'm just trying to keep the example short for the sake of this video, so bear with me. Okay, so how could allocating the LLC owner's losses beyond their investment ever have economic at risk, right? Bill and Ted only put $10,000 each, right? So how could they get an allocation of that depreciation? If the depreciation is $30,000 and they each get allocated half of that, that would be a $15,000 loss allocation each, but they only invested $10,000. And after you do it the first year, then they would have already wiped out any investment they made. So they're getting allocated these deductions in excess of their investment, or what they really have at risk. And so this is the critical question that the Treasury wrestled with when they wrote the minimum gain regulations. Ultimately, Bill and Ted could only lose $10,000 each, or a total of $20,000, which is, you know, which is only part of the first year depreciation deduction of $30,000. That remaining $10,000, $30,000 minus the $20,000 that Bill and Ted invested, the remaining $10,000 in year one and all the subsequent depreciation of $30,000 each year doesn't really seem fair that it can be allocable under the typical economic effect analysis to Bill and Ted, because they don't really have risk of loss. Who has risk of loss? Well, the lender who loaned money to the LLC, even though without any guarantee from Bill and Ted. But the lender probably doesn't really have too much risk at loss, because what can they do? They have a security interest in the building or the real estate, and they can get the real estate, right? And that's what really the Treasury was thinking about when they wrote the regulations on minimum gain, because what they looked at is they said, okay, well, the difference between a hypothetical sale of the real property for the value of the debt. So remember, the debt was $280,000 mortgage. And let's, and so if you basically said, well, what if we sold the property for $280,000? And now the book value of the property after year one is only $270,000. How am I getting that number? Well, we bought it with the real property for $300,000. We depreciated by $30,000. So the net book value would be $270. So if you could sell it for $280, the value of the debt, and the book value is only $270, then you have a $10,000 minimum gain. That is the minimum gain concept. The difference between a hypothetical sale for the value of the mortgage and the book value or tax basis of the property in any given year is that year's minimum gain that's in that LLC. Now the concept then is that minimum gain, if you can measure that minimum gain can actually be used as justification for allocating non-recourse deductions to the LLC owners, but only if the operating agreement includes a minimum gain chargeback provision. Now that is a term, a tax terminology, minimum gain chargeback provision. A non-recourse deduction is the deductions that are being allocated to members or partners that correspond to an increase in the spread between the book value of property and the amount of the debt. So think about it, it's like the only way that Bill and Ted are able to get these extra deductions beyond their investment is because there's debt. And so that amount, that deduction that is by virtue of the non-recourse debt that's in excess of their investment is coming from the spread of the difference between the value of the debt and that book value of the property. So that's a that's a mechanical or mathematical proposition I've thrown out there at you. But in technical terms, what I'm trying to say is the minimum gain in property will increase as you have these non-recourse deductions, or every year as you have depreciation of $30,000 a year, you just keep increasing the hypothetical minimum gain on this property. So the minimum gain chargeback provision is an agreement among the owners that to the extent that you've used this minimum gain amount to justify allocations to the partners, allocations of losses beyond their investment to partners or members, well, to the extent that you've done that, the members are agreeing that the LLC will make a special allocation of income when the minimum gain somehow decreases, right? Minimum gain is increasing as you have depreciation deductions, but in theory it could decrease in certain circumstances. And if it does decrease, you will charge back that decrease if it was used for allocations to the partners who used it. Now that's a mouthful. The chargeback must occur before any other allocations are made under the operating agreement for that period. And there are a number of ways the minimum gain might decrease now. But the simplest example would be, well, what if the LLC generated enough cash flow and just paid down the debt, right? The minimum gain was the amount of the debt minus the book value of the property. So as you kept depreciating the property, if you don't pay down the debt, you depreciate the property, your minimum gain increases. But if you start paying down the debt, then your minimum gain, that spread, will decrease. Okay. Let me throw that into our example so we can talk about it in more concrete terms. Suppose Bill and Ted agree to change their allocation of income in year 2 to a 60-40 split instead of 50-50, right? Due to their changing commitments of time and energy in the project. That's why they go to 60-40. And suppose in year 2 they sell the property for $320,000 and they pay off the $280,000 mortgage. Well, I'm assuming that this generates $50,000 of taxable income, a $320,000 sales price minus the $270,000 book value at the end of year 1. Since Bill and Ted each had used $5,000 in minimum gain to justify their allocations of non-recourse deductions in year 1, right? Then the decrease in minimum gain will cause Bill and Ted to each recognize $5,000 of income. This is a result of the chargeback provision in their operating agreement. then the remaining $40,000 of income may be split in accordance with their agreed 60-40 allocation. So what we're saying is each owner has to get a $5,000 allocation of income regardless of their agreed 60-40 split because they agreed to a minimum gain chargeback. Then the remaining income for the year can be split 60-40. What I'm saying about that is that the minimum gain chargeback provision supersedes how the owners would otherwise intend to allocate income. And that's always going to happen whenever the minimum gain decreases, which in this case it decreases because the property is sold and the debt is paid off. So if you use minimum gain to justify an allocation of non-recourse deductions that owners are not at risk for, you have this issue of having to have the agreement for a minimum gain chargeback and then track and charge back appropriately at the right time. Now, this video doesn't deal with the question of whether the owners would really get the benefit of deduction on their individual tax returns. So if we go back to year one and we say, okay, we allocated Bill and Ted 50-50, $15,000 loss each on their tax returns. That was $5,000 each in excess of what they invested because of they had minimum gain available and they had a minimum gain chargeback agreement or provision in their operating agreement. So all of that being said, we did that. And so then if you chase that through and you say, well, does that mean they actually got a $15,000 tax deduction on their 1040 individual tax returns? I'm not necessarily saying that. An owner's tax basis is also determined in part by their share of minimum gain, but that's a different topic for another article, or another video, as I should say. For now, I'm just concluding that a minimum gain chargeback provision is the first step in providing some help to being able to allocate those deductions to Bill and Ted, and that minimum gain chargeback provision is something that we'd want to have in the LLC operating agreement. Okay, well, that's it for now. If you're enjoying these videos, I hope you subscribe, like the videos, tell your friends and colleagues about it, because the more we build this community, the better it'll get, and I hope to keep doing these videos for you all in the future if you're finding value in them. For now, I'm going to get back to gardening.